It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. On to the House. President Trump's tax bill faces Republican resistance with a vote scheduled today. No delay. The president sticks to his July 9th tariff deadline, threatening Japan with levies up to 35%. And the biggest banks on Wall Street boost their dividends after passing the Fed's stress tests. Well, momentum starts to wane. We hit all-time highs, and then we fell yesterday. There's a big rotation out of momentum and into value stocks that in some way continues into the future session this morning. S&P higher by about a tenth. NASDAQ underperforming. Russell 2000 outperforms. That's up 0.5%. We've also seen yields tick higher both yesterday and today after we had JOLTS data yesterday showing a still tight labor market. So some of the cuts for the Fed starts to get priced out. We're moving up by another basis point, about 1.5 for your 2-year yield. Your 10-year yield's up 4 basis points this morning, a chunky move on the long end. We are at 4.28 for your 10-year yield. Let's look at some of the stocks moving in the pre-market now. With that is Joe Easton. Hey, Joe.
Hey, Danny. So we've got Paramount Global in the spotlight today. The shares edging higher as the company reaches an agreement with President Trump, who had sued the firm over its coverage of the election. The firm had shown on their CBS channel 2 versions of an interview with the presidential candidate Kamala Harris, and that had led to a lawsuit from Trump, who had sought around $20 billion in damages, but they're looking like they're going to pay around $16 million to settle that. That is taken positively. Meanwhile, Stellantis getting a little boost as well, seeing some strength in some of their truck names in their latest quarterly sales report. The overall numbers, the overall quarter actually look pretty weak, but it is the truck sales making up for some weakness in Jeep and Chrysler as well. Then finally, Goldman Sachs analysts ditching their Crocs this morning, no longer wearing them to the office. They are downgrading, or at least initiating a sell on Crocs this morning, and that stock is declining 1%. They do have a price target significantly lower than where we are trading currently. Keep an eye on Crocs today, and as usual, check out the Before the Bell opening wrap for a summary of these news and more. Danny.
Joe, did you just imply that you have a pair? Is that what that was?
Yeah, well, it's whenever I should wear them on set, really. It would be, I'd glide around a little bit more easily than these clumpy loafers.
Joe, the picture of fashion. I hope you put them in sport mode just to make sure you can do those market checks just as well.
Absolutely.
Joe, thank you so much. We'll catch up with you later in the hour. And this hour in just moments, we'll speak to Allspring's Lauren Van Biljon on the Fed's rate path. Later in the hour, we'll speak to Signum's Nico Fitzroy on the looming tariff deadline. First, we take you live to Sintra, we'll take you live to Sintra for a conversation with Alan Taylor, external member of the Monetary Policy Committee at the Bank of England. All of that this hour. Now, speaking of Sintra, Chair Powell spoke there at the ECB forum yesterday on the rate path ahead for the Fed.
We are going meeting by meeting. I mentioned how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve. But as I mentioned, a majority of us do feel that it will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
Allspring's Lauren Van Biljon weighing in with her outlook, writing, quote, current pricing out of U.S. is for 2 cuts this year. Reality could be more binary, i.e. nothing at all from the Fed until 2026 or a series of rapid cuts into year end. Lauren, I'm pleased to say, joins us now. She's fixed income portfolio manager at Allspring Global Investments. Lauren, so great to see you this morning. So what is the risk, the greater risk for this bond market then? No cuts this year or a series of cuts?
I think the latter. On balance, I think this is a Fed that wants to cut, is looking for the data to let it cut. And I think we'll probably get there for the September meeting. The jobs numbers have been obviously the driving force of late. And just enough sort of stability leaning to weakness there that I think we'll see some cuts out of the Fed this year.
It was a Powell in Sintra, though, Lauren, that was quite relaxed. He repeated this thing that he has said previously, that had it not been for tariffs, they might have been cutting. He also went on to name what keeps him up at night. The number one thing was price stability. And Bloomberg Economics' Anna Wong looked at that and said that this is a Powell who aspires to be like a Paul Volcker, who stays steadfast in the face of external pressures. And therefore, his bias will be not to cut. I just wonder what you make of that.
I think certainly Powell is, obviously his driving force is price stability. He's going to be thinking about his legacy as he hands over control of the Fed next year. But I think where rates are right now, they've kept them tight for a significant amount of time. And I think looking into the second half of this year, yes, there's upside risk from tariffs. We'll certainly we're seeing that playing out in, say, household goods or tech. But I think there are two big components that are going to help sort of ease the Fed's mind, and that's energy and that's housing. And I think the outlook for both of those is disinflationary over the next couple of quarters. And I think that'll let the Fed look through that sort of the price shock of tariffs and focus on some potential easing.
So given that they could have some potential easing, Lauren, is this a front end of the curve that you'd want to be buying right now?
Yes. I mean, Allspring, one of our big calls this year has been for that steeper curve. And it's been interesting that it's been bull steepening rather than the bear variety, perhaps. But it does say to us that where the curve is right now, and given, say, tax risk and the lingering policy risk, yes, it does feel that bull steepening has got more to come. I think particularly the very long end of the curve, that continues to struggle to attract a lot of interest, both from domestic and offshore buyers. But yeah, that sort of more intermediate end of the curve, yes, that's where we could see more of the action.
Well, we've had that narrative really bubble up this year, Lauren, that especially external buyers, foreign buyers, would start to snub the long end of the curve. And yes, it has been under pressure, but auctions for the most part, yes, there's been a 20 here and there that haven't looked great, but auctions for the most part have drawn in demand. What do you make of the state of demand, especially as it pertains to foreign buyers of this Treasury market?
There's been a couple of really interesting things happening in the last couple of months. Because as you say, auction demand has been fine, right? That's still clearing. It's still coming through. I think there has been a preference for shorter dated securities. And I think where a lot of the action has been on hedge ratios. So you've had foreign investors perhaps hedging a far greater share of their US holdings than they might have done in the past. And I think it's been that shifting hedge ratio that's played a role in the weakness of the dollar. You know, the US bond market it's a deep and liquid and incredibly important bond market, and that just can't disappear overnight. I think there is a risk that your, say, marginal buyer of treasuries is now thinking about alternatives. That's certainly a possibility and something we're looking at very closely. But I think people are still very happy to be invested in the US, perhaps just a little bit more cautious on how they're hedging the currency exposure.
Lauren, to your point, it's the most deep and liquid market. So what is the alternative for the marginal buyer that wants to find one?
Looking at flows, the answer seems to be a little bit of everything. Certainly at Allspring, we think securitized credits offering a great opportunity. And perhaps barbell to that, emerging market local currency debt has had an absolutely stellar 2025, both on the bond and currency fronts. And that could continue to attract interest. Obviously, Europe has seen some flow as well, but to me, that perhaps is slightly more played out at current valuations. So I think you can look at some of the smaller emerging and developing economies where you've got decent yields, you've got sound policies, you've got sort of a wellspring of domestic demand, perhaps offering some insulation from trade tensions. And you can say that is still an attractive destination for investment.
All right, Lauren, we're going to have to leave it there. Thank you so much for joining this morning. Lauren Van Biljon of Allspring Global Investments. Let's get you some other stories now that are trending on the terminal this morning. The Trump administration is halting key Ukraine weapons deliveries as Russia steps up its missile and drone attacks. The White House confirmed an earlier report from Politico on the stoppage. It said the move came after U.S. munition stockpiles had fallen too low. President Trump says Israel has agreed to a 60-day ceasefire in Gaza. The president said that Qatar and Egypt will deliver the final proposal to Hamas. Israeli Prime Minister Benjamin Netanyahu is set to meet with Trump on Monday. Meanwhile, KKR has agreed to buy Spectris for around $5.5 billion, outbidding an offer from a consortium led by Advent. The private equity firms have spent the last month trading bids for the British company, which makes precision testing equipment and software. The offer values Spectris at about £40 a share, a 6% premium on Advent's bid. Coming up, back to the House. After barely passing the Senate, President Trump's tax bill is set for another vote-a-rama today. We'll have more of that next on your brief. You're watching Bloomberg.
I look forward to the House taking legislation and getting it to the President's desk.
And you believe this bill will get to the President's desk by July 4th?
I do believe we have a good chance to get it done. I can't speak for the House, but that is the goal. And so far, we've been able to reach those goals.
I don't know what's going to happen in the House. They're going to take it up pretty soon. Do they have the votes to pass exactly what we did? I don't know.
House lawmakers returned to Capitol Hill today to vote on the Senate's version of the tax bill, which passed the chamber on Vice President Vance's tie-breaking vote. For more on the latest in D.C., let's bring in Bloomberg's Suzanne Lynch. Suzanne, what sort of uphill battle does the president's bill now face in the House?
He does indeed face an uphill battle. These votes have been very tight all along. Originally in the House vote, as we saw in the Senate when Vice President J.D. Vance had to cast that tie-breaking vote, and now as it goes back to the House. And a number of lawmakers, interestingly, both from the more conservative side and the moderate side, have expressed reservations about what they have to agree to now. Obviously, Conservatives are worried about what this means for the deficit, for the debt levels, the US fiscal policy and the Republican Party's fiscal policy. And on the other side, those deep cuts to Medicaid is an issue that a lot of more moderate Republicans are concerned about. So, it's going to be a very closely watched session, another vote-a-rama, as you say, but let's see if it gets done before that July 4th deadline.
So we have two big deadlines, self-imposed as they might be, coming up. July 4th for the tax bill, July 9th for the tariff deadline. And on that, President Trump has spoke with it. Suzanne, this is what he had to say. Let's take a listen on a quite pessimistic tone on a deal with a key ally.
We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough. And therefore, you'll pay 30%, 35%. Or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
If this is a president digging his heels in when it comes to Japan over issues like agriculture, over rice, for example, how does it suggest about the likelihood of getting more deals done by July 9th, Suzanne?
Yeah, I can tell you that those comments are being closely watched by trading partners across the world. We are really hitting crunch time now for US talks with its trading partners ahead of this July 9th deadline. The European Union, its chief negotiator, has flown to Washington. Maros Sefcovic, he's due to meet senior officials, including Mr. Greer, the US trade representative, on Thursday, and will report back in Brussels on Friday. And those comments, at least, suggest a hardening of the stance by the US president. That warning to Japan, obviously, as he said himself there's still that big trade deficit. He's concerned about the auto industry, for example. So if he's going to take that hard line on Japan, is he going to do it with the European Union too? Now, there is a feeling, we've been reporting here over the last few days, that the European Union is getting more comfortable with the idea of a 10% universal tariff. However, what they also want is some kind of carve-out or reduction for other sectoral tariffs, like be it automobiles, steel and aluminium. Also, the big question is, what is the US administration going to do about pharma tariffs? It's threatened that. They have not come so far, but is this still on the table? So to that extent, I think those comments from the president are very telling. And of course, as you mentioned there, the fact that this is all coinciding with the July 4th deadline, I think people across the world, trading partners, are looking to see, does Donald Trump get that deal done for July the 4th, so that can kind of clear the decks for serious negotiations to happen in the remaining days before the July 9th deadline?
So just on that Bloomberg story we had the other day about maybe warming up to a 10% universal tariff, does that mean that the EU is less likely to retaliate if that is indeed what comes out of these negotiations?
Yeah, I think the issue is, if they agree to a 10% tariff, well, then they were going to have to get some leeway on those other sectoral issues. And if they don't, I think then they still have this option of hitting back with their own countermeasures. Now, always with the European Union, it's a massive trading bloc, but it consists of 27 countries. So the debate that's happening in Brussels is that some countries are saying, let's go easy. We don't want to, antagonise the US and then prompt more measures. And where others, particularly France, is a strong voice here saying, listen, we're in a strong position and we cannot just accept this and not have some kind of movement from the US side on those sectoral tariffs. So I think that a basket of measures it's ready to run with are there. And that is the leverage, essentially, that the European Union has as it goes into these final days. But look, as I say, happy to live probably with the 10% tariffs, but needs movement in other ways.
Suzanne, thank you very much for that, for all of your work this morning. That is Bloomberg's Suzanne Lynch. Coming up, looser stress test for Wall Street's biggest lenders boost dividends. That and more on your front page headlines. That's coming up next. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning and what the major publications are running with. First up, the Wall Street Journal, leading with China quickly gaining ground on the U.S. in the AI race. Institutional users of AI ranging from universities to multinational banks are turning to Chinese LLMs from the likes of DeepSeek and Alibaba as an alternative to Western models. And on the Financial Times, sales of European junk bonds surged to their highest level ever in June as capital continues to flow away from U.S. markets. Low-rated companies saw their issuance rise to about $27 billion. That's according to data from J.P. Morgan. And on the Bloomberg, Wall Street's biggest lenders are boosting their dividends after passing this year's less stressful Fed stress test. For more on the story, we are joined by Bloomberg's managing editor for EMEA Finance, Tom Metcalf. So, Tom, what have we seen from the banks and the resulting payouts being upped?
Yeah, well, basically across the board, payouts are up. The one that probably jumped out the most is Goldman, which is increasing its dividend effectively by a third from $3 a share up to $4. So that's a pretty big jump. And, obviously the shares previously, when it was announced they'd passed their tests, had already risen. What will be interesting to see today is, as the sort of markets digest these increases, will there be any more kind of uplift in the shares, or has it all been priced in?
So has it all been priced in? But what other optimism is priced into banks? Tom, the third best performing sector so far this year is financials, up about 9%. There's been widespread hopes for deregulation for the U.S. and really across the globe. How apt are those hopes? Do they seem like they'll be playing out?
Yeah, look, I think the sort of posture generally towards finance has obviously dramatically shifted since, kind of the dark years after the financial crisis. And I think it's that deregulation piece, which maybe is the most tangible. There's a lot of talk about support in finance in the finance industry, but what's most interesting is when, the regulators actually take action. I'm sitting here in London. There's certainly been a push for that. Obviously in the US, there's been a real kind of move towards that, which you could really contrast with what, under the Biden administration, they were trying to do with the Basel rules. It now looks like those Basel rules might not even be implemented in kind of the extreme case for the US banks. And that's cascading across the world. So, almost every region you look at, finance, and what's quite a turnaround, is now seen as there's a lot of trends pushing it towards, higher profits thanks to, sustained higher interest rates. And of course, the politics and the regulation sort of easing against banks.
Well, there's the political side of it, and that coming from Washington, D.C. and other lawmakers. But there's also the monetary policy side of it, Tom. When you have the Fed talking about things like SLR reforms or even having a more lenient stress test this time around, is this a Federal Reserve that's trying to gear American banks to be able to handle ruptures more readily?
Yeah, look, I think there's been a bit of a change in tone, and I think generally there's a bit more acceptance that, look, you can't, exclude risk. As basically what the role of the regulators is to make sure people are taking that risk, at least informed of them, and sort of are in a position to kind of make that decision. And, certainly where the US, leads, everyone else is going to be following. So in the UK, similarly, you've gone from almost quite a nannying posture from regulators to at least public statements saying, hey, we're looking to encourage growth and we're not looking to sort of clamp down too stringently on banks that follow the rules, but are also out there looking to make money.
All right, Tom, thank you very much for that. That is Tom Metcalf. And again, the bank's not moving a huge amount this morning, but they did see larger moves on Tuesday. For example, Bank of America moving 1.7% on Tuesday in reaction to passing the stress test. Overall, your American equity session in this futures trade, little change this morning, up about just 0.1% after declining yesterday. The dollar snaps back some of the losses that it has seen. It is gaining with your 10-year yield and really duration under pressure this morning. Yields higher by nearly 4 basis points. Coming up, trade tensions are on the rise between the U.S. and Japan. Nico Fitzroy of Signum Global Advisors joins us next to weigh in on the talks as the EU trade advisor heads to Washington, D.C. That's next on your brief. Stay with us. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday. On to the House. President Trump's tax bill faces Republican resistance with a vote scheduled for today. No delay. The president sticks to his July 9th tariff deadline, threatening Japan with levies of up to 35%. And the biggest banks on Wall Street boost their dividends after passing the Fed's stress test. So the momentum wanes. Earlier in the week, we hit all-time highs, only to see declines yesterday and a little pop higher on your future session, about 0.1% for S&P futures. Worse for the NASDAQ, even more for the Russell. There's been this weird and curious rotation out of momentum and into value, and that seems to continue this morning. For the bond market, it is continued pain. We are higher, especially on the long end. Look what's happening for your 30-year yields. We are higher by nearly 5 basis points at 4.8. The bill making its way through D.C. and also a more tight labor market in the JOLTS data yesterday will tomorrow confirm that. Your 10-year yield at 4.28. Let's get some stocks moving in the pre-market. With that is Joe Easton. Hey, Joe.
Hey, Danny. So we've got Paramount Global in the spotlight today as CBS settles a lawsuit with President Trump. Now, Trump had sought around $20 billion in damages for some of their pre-election coverage, where CBS showed 2 versions of an interview with Kamala Harris. Trump wasn't happy about that, but they've settled this, and they are only going to be paying around $16 million. So pretty loose change in comparison to what was sought. Then we move over to the health insurance space. A big decliner today, Centene, plunging this morning as they pull their guidance, seeing around a $1.8 billion hit due to a weakening market, set to be one of the biggest decliners in the open this morning. And then finally, Goldman Sachs analysts are shunning Crocs, no longer wearing them when they're doing their research reports. They're cutting that one to sell, or at least initiating with a sell. This is due to competition. Believe it or not, there are actually competitors to Crocs, according to Goldman Sachs. They think you should be selling Crocs shares this morning, and the stock is declining 1.5% this morning, Danny.
What is a competitor to Crocs? Who else makes shoes like that?
It's so unique. I mean, how do you substitute a Croc?
Yeah, because you'd have to be out of your mind to make a plastic shoe that looks like that, Joe. I'm going to leave it there. I'm going to get some hate mail for that, Joe. Thank you so much for your work this morning. All right, let's get away from Crocs and switch our focus to trade. President Trump ramping up his tensions and attacks with Japan for a 3rd straight day.
We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough. And therefore, you'll pay 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
Meanwhile, the EU's chief negotiator, Mariusz Sefcovic, is now also headed or is in Washington, D.C. right now, and he will be meeting with the U.S. Trade Chief Negotiator Jameson Greer and Commerce Secretary Howard Lutnick. Now, our next guest writes, we believe that U.S. President Donald Trump is likely to raise tariffs on many countries, including those of the EU around the tariff deadline, despite regular media chatter of progress in transatlantic talks. Joining us now is Nico Fitzroy, Senior Analyst and Partner at Signum Global Advisors. Nico, really wonderful to see you this morning. So what is your expectation as to whether the EU gets some sort of agreement with the U.S. by July 9th?
Well, I think progress has been made over the last couple of weeks. Bloomberg obviously reporting earlier this week that the EU accepts now that a 10% blanket tariff will remain in place. And I think that's an important step towards a deal, because that 10% blanket tariff was something clearly that the US was not willing to give any leeway on. So that does make a deal a little bit closer potentially, but does it make it likely? And I think the problem here is the two things that come because of that perceived concession on the blanket tariff make a deal still more difficult than not, I think. Two things. Firstly, from the EU's perspective, accepting a 10% blanket tariff is perceived by them to be a concession. From the US side, it's not perceived to be a concession. So the US doesn't really feel like it has to give something up in return for that. That's a problem, and that's been one of the problems, I think, throughout the negotiations, the two sides talking past each other a little bit. The other thing is that actually the EU, in order to accept that 10% blanket tariff, it wants something positive to come from the deal, and that basically will be either exemptions for kind of key, national champion type sectors, alcohol, pharmaceuticals from that blanket tariff, or a reduction in auto tariffs. Both of those look difficult to agree. I mean, Trump hasn't shown much interest at all in exemptions from the blanket tariff. And when it comes to the autos sector, we've heard him many times talk about asking the question of why we buy so many cars from Europe. Germany treats us very badly when it comes to cars, etc. This is a big bugbear of Trump. And I think he's therefore less likely to make concessions on autos for the EU than he was for the UK. Obviously, the UK did get a deal on quotas there. So the balance of probability still suggests that a deal is unlikely despite some of the positivity there. But I would concede it's a little bit closer.
Internally, though, you have the likes of Merz, of Maloney pushing for a faster deal. Do they hold enough influence within the EU to change the messaging to maybe something like a bad deal at this point is better than no deal?
Yeah, I mean, it's definitely true that there are a number of leaders that potentially want a bad deal rather than no deal. I think the problem here is that, well, you've got a couple of problems. Firstly, they have to achieve some kind of concessions from the US. And so maybe a reduction in steel and aluminium tariffs is something the US can grant. But, Germany is a great example where, okay, Merz wants a quicker deal. He wants a deal that maybe isn't even that good as long as he gets it quickly. But for him, the most vital thing of all is getting reduction in autos tariffs. So, okay, he wants a deal, but actually what he really wants is something that is very difficult to achieve. The other problem is a collective action problem within the EU. Even if you want a quick deal, different countries have different interests, and they're all pushing for different types of concessions they want from the US. And that means you get a whole host of demands across different sectors. So even though Maloney and Merz may appear to be pulling in the same direction, actually the things they probably want in return from the US could potentially be quite different. And that might be true across a whole range of different countries. So that collective action problem means that kind of unity in pushing for a quick deal is never quite what it seems with the EU.
Well, in order to do something like retaliatory tariffs as well, Nico, you probably need that unity. So where does that stand? What is the likelihood that the EU pushes back after the July 9th deadline if there is no deal and tariffs are increased?
Yeah, right. I mean, unity, is the biggest problem of all when it comes to unity is how to respond to the US. I think so far the EU has been very dovish in terms of its response. It hasn't actually implemented anything in retaliation to Trump's tariffs so far. It's passed one package worth just over 20 billion euros in tariffs that it can, implement. I think on July 14th is the date they're talking about, but essentially, immediately after Trump imposes any more tariffs. There's another package worth 95 billion-ish euros. In our view, the EU is going to remain dovish for a couple of reasons. I mean, firstly, the possibility of negotiations with Trump will always remain. There's always a chance of negotiating something even after July 9th. And that gives an incentive or a disincentive, I suppose, from the EU to respond very, very strongly. I think also what we saw, one of the examples that people talk about a lot is China, which went toe-to-toe with the US, responded with retaliatory tariffs at exactly the same level as the US, and ultimately the US kind of backed off. I think some people say that that's a kind of template for countries to use. I think when it comes to the EU, it's an example of why it can't escalate in the same way, because EU countries are not willing to live with 100+% tariffs potentially for a prolonged period. And certainly they don't believe they can outlast Trump on this. So retaliation is likely to remain relatively weak from the EU. I think probably potentially just limited to that 20 billion-ish euro package if they have to do something. The big question is whether they target US big tech firms and banks and other services. I don't think, to go back to the point about unity, I don't think there's enough unity among EU countries to do that. there are still a number of countries like Italy, Ireland, some of the Baltic states that really rely on security guarantees from the US. These countries don't want to retaliate at all. And so that normally means you get something close to the lowest common denominator, which means a fairly dovish response.
Well, there's also the more recent example of Canada that didn't want to remove their digital tax, and they got called out quite aggressively by Trump. And it's non-tariff barriers that Trump is also quite upset about when it comes to Europe, things like VAT, digital regulations, and digital tax. Is it really realistic that the removal of those barriers are on the table for Europe?
Yeah, I think it's a great point. I don't think the removal of many of those barriers is on the table. The removal, for example, of the Digital Service Act and the Digital Markets Act, these are not things realistically I think the Commission can offer. VAT, there is some positivity here, which is that VAT appears to have been reduced in terms of how much, not reduced as in the US is talking about this less. It may still be an issue, but it doesn't appear to be one of the sticking points in negotiations, which is potentially more of a positive. And I think when it comes to some of the climate and ESG regulations, actually a lot of member states are pulling in the same direction as Trump. So Merz and Macron, for example, among many others, are pushing to reduce the scope and potentially delay the implementation of a whole range of different pieces of EU regulation. And they would have done that anyway. So the interesting thing there is that they can say that they are doing that because of Trump and as a concession. So it's not, non-tariff barriers, there is definitely some overlap. But in terms of getting rid of some of the tech regulation, that remains very unlikely. And so that will always remain a problem, I think, in the relationship.
Nico, we're going to have to leave it there. That was an absolute masterclass. Thank you so much for joining. Please come back again soon. Nico Fitzroy of Signum Global Advisors. Now let's get you some other top stories that are trending on the terminal this morning. The Trump administration is halting key Ukraine weapons deliveries as Russia steps up its missile and drone attacks. The White House confirmed an earlier report from Politico that artillery rounds and air defensives has stopped flowing from Washington to Kyiv, reportedly after a review that led to concerns that U.S. munitions stockpiles were falling too low. President Trump has said Israel has agreed to a 60-day ceasefire in Gaza. The president, posting on Truth Social, said the U.S. will work with all parties to end the war and that Qatar and Egypt will deliver the final proposal to Hamas. Israeli Prime Minister Benjamin Netanyahu is set to meet with Trump on Monday. Home sales in Manhattan last quarter were the strongest they've been in almost 2 years. Cash buyers boosted the market, undeterred by a backdrop of economic uncertainty created by President Trump's trade war. A little more than 3,000 co-op and condo purchases were closed in the 3 months up to July, a 17% jump in the period last year. Coming up, we go live to Sintra, Portugal, with Alan Taylor, external member of the Monetary Policy Committee at the Bank of England. That's up next on your brief. Let's go live now to Sintra, Portugal, where Francine Lacqua is standing by with a top voice in central banking. Francine.
Yeah, thank you so much, Danny. I could not be more happy to speak to Alan Taylor, of course, from the MPC Bank of England. Alan, thank you for joining us. I have a million questions on cuts, how big, how strong. But first of all, you've been in the job for a year. What's been the biggest difference?
Well, thank you, Francine. It's a pleasure to be here. It is coming up on a year, and I think that's causing me to reflect, especially here in a breezy Sintra, that the economic winds have been shifting. So the way I would describe the evolution of my outlook and my thinking is I think a year ago, as in many central banks, the view was that we were on track for a soft landing. We'd had a burst of high inflation. Rates had been elevated to counteract that. With high interest rates in the past, you would have normally expected some kind of slowdown in the economy, but that kind of damage wasn't happening. So there was a lot of optimism around that, and I think a sense that we were progressing back towards target without undue economic damage. Now things have shifted. I think I would say now that soft landing is at risk, in my view. We've seen the economy slowing down in the UK. Inflation in terms of core measures coming back towards target. There is a bump in 2025, which we're going to talk about, I'm sure. But now my worry is when we get into 2026, we're coming back to target, but the danger could be overshooting to the other side, where we end up with the economy below capacity and inflation potentially undershooting. So I think that's the sort of then and now.
Yeah, and Alan, you've been very clear that you think we're still far away from where you think the neutral rate is. So would you go to bigger cuts?
I don't think bigger cuts are necessarily needed or desirable, but I think we only meet 8 times a year, so there's a kind of integer problem. You've got so many cuts you can do in a year. The market has interpreted, gradual to mean once a quarter. But if you feel that a slightly faster easing might be needed, if you're worried about mounting downside risks, then you need to get an extra cut in somewhere. If you think maybe 5 cuts are needed, so it could come at different points depending on how the centre of the committee moves.
Will you vote for a 50 basis point cut again?
Well, I'm not going to prejudge my vote. I think everything has to be taken into consideration afresh each meeting. So, as everyone likes to say, we're not on a preset path. It almost doesn't need to be said. But you have to look at the data afresh each time. And we're going to be getting new information on the trajectory of inflation. We're coming out with a new forecast in August. We're going to have more information about where wage settlements are landing, which is a particularly important indicator for me and for the rest of the committee. So I think we're going to look at that anew each time.
How much do you worry about the labour market and it actually deteriorating quickly? We've seen signs in certain data.
Yeah, I think we're starting to see cracks there. So the unemployment rate is rising in our new forecast. Latest forecast, it's going to top out at around 5%. Vacancy to unemployment ratio has been coming down very steadily. It was tight a year ago. That's another big change. And staff judgment now is that we've got some labour market slack. So I think we're in a point now where we've got slack in the economy, we've got an output gap. And so I'm comfortable there that the underlying inflationary pressures in terms of the demand and supply balance are now tipping the other way. So I think that's helping the disinflation process along quite helpfully.
In inflation, though, do you worry about second-round effects? I mean, again, there's concern about what happens after the trade negotiations in the next couple of weeks and months.
Right, so I think I'd maybe separate that into 3 little chunks. I know you've got a lot to get through, but I'll go with the rule of 3 here. So second-round effects, I worry about those most with energy, right? So energy is a key input. It's well up the chain in terms of, it's upstream from a lot of things. It's an input used in many other sectors. So the energy shock, look back at the history of the last 50 years, what's taken us away from target the most? It's been 2 big energy shocks in the 70s and now. And so second round effects there are a big worry. Something like food, it's more of a final product. I don't worry about the transmission through the input-output structure of the economy, but you worry more there about does it dislodge inflation expectations. So I think the key to me there is to focus on expectations measures. They don't always disagree. Households, financial markets, businesses say different things. But I think that's maybe less of a concern than if we have an energy shock.
But so given, I mean, there was because of the energy shock, is there, a worry that actually you have the deteriorating labor market, but also inflation going through a tough time in the next couple of months?
Yeah, so this was really why I was kind of a little bit in wait-and-see mode at the start of the year. In the first quarter, the first 2 meetings, I was hit with a lot of new data. The hump became apparent. A lot of that was from administered prices, so it wasn't really something predictable out of the demand and supply balance in the economy. It was news about electricity, about water, about taxes, about any number of things. Those stick around. Once they're in for 12 months. But we're fairly comfortable at the moment saying when that 12-month period comes to an end, they're going to start to fall off in 2026. So I think as we got more comfortable and more data came in, and the underlying measures, particularly the wage inflation I mentioned, we started to see wage settlements, which were coming in absolutely in line with our agents' pay survey. As we went through 2025, over the last few months, I felt more comfortable that that disinflation process is intact and it's progressing as I would have expected.
I need to ask you about QT because we had a hint yesterday from Governor Bailey that we may be getting a smaller overall balance sheet runoff in the next year of QT because of constrained liquidity at the end of the curve, at the long end curve. Do you think sticking to the £100 billion runoff would actually be too rapid?
Well, as the Governor mentioned, we're about to go into the review of that. It actually starts this week, and we're going to spend 2 months poring over the figures, thinking about the situation, And the context matters. We're in a different place than we were a year ago. So that has to be taken into consideration. I mean, the broader context here is that we're transitioning to a different regime in the long run, with liquidity coming through repo rather than through outright asset purchases. And that should be a gradual transition, and that's what we have in mind. So I think that destination hasn't changed. But just as we said a moment ago with the rate decision not being on a preset path, I don't think one should think of the QT being on a preset path either. So it's a very much a live decision. And I think we have to look at the context, liquidity in the market. How does it interact with monetary policy? We're voting as the Monetary Policy Committee. Do we think asset purchases and sales are perfect substitutes for bank rate? That may not be strictly true, not without a lot of very special assumptions. So I think all of that is going to be taken into consideration.
Okay, Alan Taylor, thank you so much for joining us. I have 1,000,001 other questions.
I'll come back.
So you'll have to come back. Of course, that was Alan Taylor of the MPC. Danny, with that, I'm going to send it back to you in New York, and we'll have plenty more throughout the day here from Sintra.
Francine, thank you so much. Really looking forward to your continued coverage and excellent coverage so far. Francine Lacqua in Sintra. Coming up, we're going to get you set up for your trading day. More jobs data ahead. This is Bloomberg. Welcome back to your brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Wednesday. We're going to have more jobs data. The Challenger job cuts come at 7:30 a.m. Eastern, and then we'll get the ADP employment report at 8:15. Plus, Tesla's second quarter sales numbers are expected this morning. And the House of Representatives convenes at 9 a.m. House leaders say that they expect a full chamber vote on a rule that will pave the way for a final vote on the Senate's mega tax bill. All right, some individual movers this morning. Centene pulling its 2025 guidance due to an insurance market trends, earning $1.8 billion in revenue. Those shares a massive leg lower by 26.5%. Elevance Health, Centene also dragging down other health insurers down with it. That's down 4.5%. Finally, Adobe, that is some sell-side action for you. Cut to a sell at Rothschild's. The price target is at $280, currently trading at $30.86. Let's take a look at this bond market because it is under some extreme pressure after a decent first half of the year. It was yesterday's JOLTS figures that showed more openings, maybe a tighter jobs market than had been expected, plus the big, beautiful bill making its way through Washington, D.C. Does the very staid, sanguine nature that we have seen of this bond market over the past month get disrupted? 30-year yields, check this out, up more than 5 basis points at 481. All right, that's it for your brief surveillance. We'll take things from here. You're watching Bloomberg.